I would say don't buy 40 stocks, but you could buy 4 or 3. And even if you bought 3 stocks after researching them properly, the biggest asset you have is yourself and your ability to work at Google and produce cash flows and so on.
So I noticed that you haven't talked about the importance of the catalyst. I mean the catalyst for the correction of the undervaluation of financial assets such as stock. Your suggestions regarding situations like this, what do you think about the importance of the catalyst?
For the most part, you're right. I have ignored the importance of a catalyst. I think catalysts are not required. In most cases, value is its own catalyst. And I would also say that when you're buying businesses, let's say below liquidation value, for example, um, uh, in my book, there's no such thing as a value trap. I think there are mistakes in investing, but not value traps. So in the end, everything is fairly valued. And so to the extent that you end up with a less than satisfactory return on an investment, it probably has less to do with whether the catalyst there or not, and more to do with just the nuances of intrinsic value of that business. So I have actually found in many cases that, in fact, the catalyst actually flies in the face of uncertainty. Because if you have a catalyst, you don't have uncertainty. And just the nature of the type of investor I am, I prefer to buy low risk, high uncertainty and let the catalyst work itself out. And it has, for the most part, I would say that, from 94, which is what 5 years before I started my fund, till 2013, before fees and all that, it's been a little over 26% a year. And that engine has not needed catalyst. But there's more than one way to skin the cat. And the Seth Klarman format of investing, even though it's value investing, because value investing is a very big tent, is very different from the Buffett method of investing. One simple difference is Baupost has more than 100 investment professionals. And at Berkshire, there's one. You might say 1.5 with Charlie. But that's it, So I think there's many different ways to skin the cat. Seth's approach certainly has worked for a long time. But my personal preference and approach is to not bother with catalysts.
Buffett talk about the passion, about what you are doing, right? I think it's like Warren Buffett doesn't really care about money. He loves what he's doing, right? Okay, do you think that's what you are doing now? Do you love what you are doing? And do you think that's really, really important? Another thing is that, do you think sometimes this may become an obsession? Because from reading Snowball, I have the impression that investing become an obstacle of Warren Buffett's family life, right? How do you adjust that? Yeah.
Right. I mean, I would say that my take is that Buffett is a very aligned individual. In the sense that he's absolutely pursuing what he loves to do. He would be bored out of his mind if you sent him fishing forever, or sent him golfing, or just asked him to do all these other things which he has no interest in doing. So I think that he loves the game of investing. He loves, more than investing, he loves actually buying entire businesses. So he's absolutely aligned on that front. And, the thing is, you can, I think, optimize on some variables. So if you look at a person like Gandhi, Gandhi's son became a male prostitute. Okay. And in fact, Gandhi neglected his kids. So there could be an entire debate we could have on whether Gandhi had done the right thing or done the wrong thing. But that, so to some extent, I think the thing is that we are human, and it may well be that a person like Gandhi could not have optimized on both fronts. You have the same issue with Nelson Mandela, right? So if you look at Nelson Mandela's personal life, there's all kinds of issues going on with the spouse and so on. And in Buffett's personal life, you've had, in fact, I always tell my wife that Warren was given a mistress by his wife. And I tell my wife that so that she's aware that that's an option. And and so far she's not pulled the trigger on that option. But there's still time. And so my take is that I think there are many good traits for Warren Buffett that have nothing to do with investing. I actually admire the way he even raised his kids and so on. But I think that what we are probably best off doing when we look at these, kind of iconic figures is not focus on so much the kind of minutia, because you're going to find things in the closet that will make your skin crawl. But I think look at the bigger picture and say, what can we take from there that can be useful. So.
Hi, I have a two-part question. The first is we had a speaker last week, Michael Moibison. He talked about untangling skill and luck in business and investing. And I thought it was very interesting. He gave the example of Bill Gates and how his mother knew someone at IBM, and that was part of the reason that he was introduced to that opportunity. Would you care to comment on that?
Yeah, but I think that there's a lot of other people whose mothers know all kinds of people. And I would say, yeah, I would say with Bill. So if you also look at the book Outliers, for example, it talked about the 10,000 hours and all of that. So Bill Gates, a large part of the success of Bill Gates was when he was born, right? So if Bill Gates were born 10 years before or 10 years after, it wouldn't have mattered who his mother knew. So I would say that that timing and such was definitely gave him tailwinds, very significant tailwinds. But I would also say that the Bill Gates and the Larrys and the Sergeys of the world would tend to do well, even in the face of headwinds. They would not do as well as they have done, because to do as well as they've done, everything has to line up perfectly.
Right. Okay.
But I would still say that you could throw Bill Gates in the fish tank with a whole bunch of other folks, and he'd come out ahead.
The second part of my question is I recently saw a program about the Salton Sea, which was a very popular tourist area in Southern California in the 50s and 60s. And there was huge investment in that area and what seemed to be very little chance for loss. And then there was a flood in 1976, which decimated the area, and it never recovered. I'd like to get your comments on that. Because, for example, if you bought motels in that area, it would have been a total loss.
That's right. It's like I said, I think the thing with investing is there are no absolutes. So you're trying to make what I would say are high probability bets. And certainly if you are a Patel who's just left Uganda with Idi Amin breathing down your neck, and all you can do is buy one motel, then, and that's the nature of most business owners, is in certain times of their career, they will have extreme concentration risk. And it's pretty normal. We have so many bankruptcies that happen in the US all the time. And many of those are not their fault. They just happen to be just in the, just dead center of a tornado. And so you get hit. So it's just the nature of the beast. So the good news you have as a passive investor is you can spread it out a bit. So I would say don't buy 40 stocks, but you could buy 4 or 3. And even if you bought 3 stocks after researching them properly, the biggest asset you have is yourself and your ability to work at Google and produce cash flows and so on. So you have another kind of, I would say, ace in the hole if you have that sort of situation. So I think in your particular circumstance, you don't need to go all in one place.